It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Yes, it is the Real Estate Breakfast with your latest updates on the Australian property housing market, as heard on Spotify and Apple Podcasts from Perth to Penrith and all of those markets in between. Remember, we are not talking about any property listings, just the property insights and data and market trends from week to week. Yes, it is your front row seat as we talk to the property experts around the country. Hope you had a fantastic weekend. It is a Monday, June the 15th. Now, the negative gearing and CGT changes, they have dramatically shifted investor attention into new housing stock. Many talking points here, and many investors are now asking whether new builds have become the most tax-effective property investment available. Have the budget changes fundamentally changed the way you, the investor, thinks about depreciation and property selection? I bet there's been a lot of conversations around the country with investors talking to their experts for advice. On that note, let's go to Sydney right now. We're catching up with Tyron Hyde. He is the CEO from Washington Brown. And welcome, Tyron, to the Real Estate Breakfast. Yes, just how busy have you been since the CGT and negative gearing decisions were made with your business?
Firstly, thank you for having me on, Craig. It's a pleasure. Look, we've certainly been busy. There's a lot of clients have been ringing up asking how the change will affect them, and obviously my staff as well. So there's certainly been some big changes afoot in terms of negative gearing. In terms of depreciation, well, it definitely does skew, in terms of negative gearing, it definitely does skew people towards newer properties. Mathematically now, it is far better to buy a newer property when you just do the maths on the table compared to a second-hand property. Not just because of negative gearing, but because a second-hand property, you can't claim the depreciation on the plant and equipment assets. So it's a bit of a double whammy, to be honest, these changes for new properties. So I think that people selling new properties are dancing down the street, Craig.
Well, many investors, of course, they are focused on these negative gearing and CGT changes, but depreciation remains one of the most overlooked tax benefits available. Even under the new rules, depreciation can improve cash flow and reduce taxable income. How much money could investors be leaving on the table without even realising it?
For something new, say for a two-bedroom apartment in Sydney, you're looking at about $25,000 in the first year alone as a deduction. Now, with the second-hand properties, you're looking anything built after 1989, you're looking at anywhere from $5,000 to $15,000 per annum. So it's quite a substantial benefit, and it really helps your cash flow, especially if you bought it before the budget. And you've also got another year now left of claiming those depreciation out as an outright deduction. Moving forward, what will happen is those, except for it's brand new, if it's brand new or commercial, they're excluded from the changes. But if it's second-hand property, what will happen is those losses that you could claim against your taxable income, they'll just be carried forward to a pool above where, when you start becoming a positively geared property, you eat into that pool. So it's still worthwhile.
Yeah, and renovations, they can help improve both rental appeal and depreciation outcomes. In fact, new assets may create additional deductions, while scrapping old assets can sometimes unlock further tax benefits. And in a market where investors are reassessing strategies after the budget changes, do you think that there is enough property owners maximising these renovation-related deductions? What do you think?
I think, no, I think the answer is no, that there's not. I think we see a lot of people that have renovated a property and they aren't aware that just because the property is old, that when you renovate a property, it starts again, the building allowance and the plant equipment reset. So you might renovate a 1800-year-old Paddington Terrace, but when you do the renovation, or even if it's bought renovated, you can claim those renovation deductions. And I think you're right. I think a lot of people don't realise that just because you didn't do the renovation doesn't mean you can't claim the renovation.
With investors now placing greater emphasis on cash flow rather than purely capital growth, understanding depreciation opportunities has become even more important. What are the most commonly overlooked depreciation opportunities hidden inside a typical investment property that you kind of give advice out on?
Well, I think you touched on one of the ones earlier there. You talked about scrapping. And a lot of people buy a property that might be, say, built in the year 2005. It's 20 years old. And they renovate it, Craig. And what they're doing, the government says that things like brickwork and kitchen cupboards, they should last 40 years. But if you were to buy a 20-year-old property and renovate it, well, you've got 20 years left on that kitchen that you might throw away. So there's what's called a balancing adjustment or a scrapping allowance that can add up to a lot of money because you've removed that. The balancing, what was left to claim, can be your deduction. And then when you put in a new kitchen, you start again. So that is probably one of the most overlooked things. And also claiming common property things. Like when you buy into an apartment building, you own a portion of the lift and you own a portion of the garage ventilation, etc. That common property stuff you can also claim just because it's not inside your unit, Craig.
You know, there's probably a lot of pressure on these investors at the moment. So can depreciation help offset some of the pressure that these investors are now facing up and down the country? I know that's easier said than done.
Because of the changes, they don't affect commercial and brand new property. I think you're going to find a lot of people moving towards that space, because you do have these added benefits of the cash flow, which is what we're talking about here. So I think the yields on commercial and industrial properties might get a little bit tighter, Craig, because there might be a bit more of a rush to that market.
We are talking to Tyron. When we come back, we'll take a look at tax depreciation schedules and understanding a depreciation schedule. That is next.
Stay ahead of the competition with the latest news, insights and data analysis on the Property Podcast that keeps you informed.
I'm not sure whether or not you're paying attention to this, but an EV price war is rewriting the rules for first home buyers. Let me explain. As aggressive price drops from brands like BYD, MG and Geely bring brand new electric cars down to around $25,000, the historic upfront cost barrier has almost vanished. And by swapping volatile petrol station prices for cheaper home electricity charging, drivers can now save a lot of money annually. And remember, every dollar not spent at the fuel pump redirects straight into a high-yield savings account towards your home deposit. Yeah, this moment in time definitely has changed the EV landscape. I know so many people over the last 2 to 3 months who have bought themselves an electric car. Do I drive an electric car? No, not at the moment, but watch this space.
We don't just report on real estate news, we take you to the source of the information. We produce more property podcasts every week than anyone else. We are your trusted guide for all things real estate.
Tyron is with us. We are talking about depreciations, we're talking about CGT, everything that was passed out in the federal budget. You don't drive an electric car, do you, Tyron?
I do, and I was just sitting here thinking about your comment then. I was thinking, if you do drive an electric vehicle and then you do get an entire charging battery pack installed, that is a depreciable asset. I just thought I'd mention that, Craig.
Well, in terms of those battery packs, funny you should mention that because I was only a couple of days ago asking AI the life of these batteries, and it was telling me, because I wanted to know the comparison between Tesla and BYD, and they gave me the answer that BYD batteries are much better than Tesla, something to do with blade batteries and new technology. They last longer. Did you know that?
I did not know that, but I do know that I've got a Tesla, and when I looked it up the other day, how long will my battery last? And it said, well, originally it was thought to be 8-10 years, but now they're lasting like 18 years in America, which is, it said, it will outlast you wanting to have that car.
And what about these lawsuits that are underway at the moment? The self-drive mode. Now, there's lots of these lawsuits where Tesla owners are taking Tesla to court saying, hang on, you got me to pay thousands of dollars for this product, this upgrade that doesn't work.
I don't trust it, so I drive it myself, but I can hear their pain.
Yes, there's no way that I would be letting an electric car drive me, that is for sure. Now, let's get on to tax depreciation schedules, because in this environment where every deduction matters more than ever, why are so many investors at the moment still failing to obtain a depreciation schedule?
Well, it's certainly not my fault. I've been trying to educate people for 30 years on this, Craig. So I think it's just a lack of understanding. Look, we get a lot of clients that come to us and we're amending their return for 10 years. And always, it's when they change accountants. The new accountant says, hang on, you've got this investment property. You've had it for 10 years. You haven't claimed any depreciation. And the bad news about that is sometimes you can only amend your tax returns for so far back. So if you have got it, bought it 10 years ago and you haven't claimed any depreciation, you might only get the last couple of years, but that's something you need to talk to your accountant about.
Yeah, so investors paying closer attention to cash flow deductions and to after-tax returns, understanding a depreciation schedule has, I put it to you, it's never been more important. So what should investors be looking for when reviewing a depreciation report for the very first time?
And just on that, it's a good point. Why is it so important? Because depreciation reports are the only what's called a non-cash deduction, i.e. it's already in the property when you bought it, right? Every other deduction, Craig, that you get for your investment property, you have to physically pay out cash, whether it be your property management fees, your rates, your taxes. And so a depreciation schedule, the deductions are in the property. You just need someone like me to work out what it is. But when you bought that property, you've bought those deductions. And that's what I want to get people's head around. You've already bought the deduction. You just got to get a report that extracts those deductions for you. Well, firstly, you've got to do, your normal due diligence, reviews, etc. I would tend to look for someone that's been around for at least 10 years. We do over these 35 years that I've been doing this. I've seen so many companies come and go. So you want to be someone to be around in case you get audited. You want a company to be at least 10 years old, and just a client list. And first thing you've got to check is, are they members of the tax practitioner board? So we have to be registered as registered tax agents now, not just quantity surveyors. And that's probably the first thing you should look at.
I think that there's going to be a few investors, maybe a lot of investors right now scratching their heads, listening in this morning saying, oh yeah, that non-cash deduction in the depreciation schedule, it's already in the property and that may have been overlooked by a lot. It's a little bit like a car warranty that is still in place with maybe 2 years to run. People forget about it and then carry out their own mechanical repairs at their own cost. Do your due diligence and engage with the right professionals and money will be found. And the other big one, as you've highlighted, if you have owned a property and you have not claimed any depreciation, you can only go so far back. And if that is the case, you'll end up missing out on money that was staring you in the face. But you didn't act quickly enough. Great points, Tyron, and that will wrap us up on our Real Estate Monday. And keep up on the great work advising property investors. And thanks for coming on to the Real Estate Breakfast.
Thank you, Craig. Thanks for having me on.
Remember to follow us on any of the podcast platforms so you never miss a real estate podcast. You can follow us on Apple, Spotify and Amazon. Know your property with us.
A lot of activity still over the weekend, queuing to get into, and I would say that it is the A-grade properties that people are recognising that are still worth buying. The 5% deposit, the share equity, all of that kind of stuff is still there.
We've seen arrears progressively increasing in Victoria for probably over a year now. Sydney as well, or New South Wales and Victoria, whose arrears are really largely influenced by what's happening in Melbourne and Sydney.
The median value for a unit across all of Greater Brisbane is sitting at just over $884,000. In the last month, we saw the unit market here in Brisbane appreciate 1.3%.
Just because there's been a tax change in the way that property taxes are treated, it doesn't mean that the fundamentals of the property market have changed. You have to be very cautious and selective about what you buy and where you buy.
We connect you to the best real estate information across Australia. The Real Estate Podcast.